Thank you. Okay, so finally, I think, we have a shipping sector which is in favor. The shipping stocks last year outperformed the S&P 500, and in general, they performed with just under 30% compared to minus 20% for S&P. So I welcome on this what I believe will be a very exciting discussion touching on some of the strategic decisions facing the ship owners of today. As mentioned, on the panel today, we have Robert Burke from Ridgebury, we have Peder Simonsen from Golden Ocean, we have Jeff Pribor from International Seaways, and Ivar Myklebust from Graham Car Carriers. So I think the theme of the discussion is how do the shipping companies today handle the ever-changing known and unknown elements that are facing them. It's said that the unexpected brings profitability, while the expected brings company strategy. So for shipping is a vital building block of what we meet at our everyday life. However, the decisions facing the companies vary from geopolitical uncertainty, macroeconomic events, new technologies, new regulations, and also investor appetite. 2022 was an eventful year, with the tragic situation in Ukraine, the continuation of COVID-19, the shutdown in China and reopening, following by inflation and recession fears, and new regulations coming online, such as IMO, EEXI, and CII. So, with that in mind, we know that volatility brings disruptions and earnings potentials. So looking at the geopolitical and macroeconomic factors affecting company strategy, I'll start with you, Bob. With a slightly vintage private fleet in the tanker sector of about 13 years, how do you handle these sort of unknown factors that you're facing in your strategy? And how are you impacted by, or how do you maneuver when you have uncertainties like you saw in Ukraine in February this year?
No. Okay. Thank you. Good to see everybody here this afternoon or this morning. The only known factors really are the order book, as was mentioned earlier, and your debt level. I can't control the order book, but I can control the debt level and how our capital is structured. And you know, running a business is like preparing for a boxing match. I think it was Muhammad Ali said, your strategy goes out the window as soon as the first punch is thrown. And I think that's true in most businesses, especially ours. Although I say especially ours, our business is the only business I know. But we are driven by the unknown, and that's what drives the profitability. So the way we prepare ourselves is we keep our debt as low as possible, which isn't always possible to do. If you're in the middle of an acquisition phase, then you may ramp up for some period of time, but you try to keep it low. And the temptation is always to buy more assets, to get your leverage higher and you have more upside. I think the chart earlier showed on the dry sector, the companies with the most upside have the most leverage. Well, there are two types of leverage. There's operational leverage and there's financial leverage. So we opt to maintain the operational leverage and keep the financial leverage low. So it enables us to survive, you know, almost no matter what's thrown at us. And that's done well for us over time because, you know, this business, the money's made in the unexpected swings in the market and the political events that move our freight demand.
Yeah, excellent. And sort of when you're faced with sort of the situation in Ukraine, there's a lot of political pressure as well that sort of defines the strategy of the company. How are you able to maneuver when you're sort of met with these uncertainties that come out of nowhere?
As soon as the crisis happened, as soon as Russia invaded Ukraine, we took a decision over the weekend to not trade with Russia, and we monitored our ships coming out of Russia that had oil on them. I think there were 6 of them, to make sure they discharged safely. And that was driven by, you know, sanction considerations, but I think, you know, our own personal conviction that we couldn't support this effort, as well as our LPs and all our investors. We talked to them individually and said, you know, we're fiduciaries. And there was a real argument within our organization about what does that mean, you're a fiduciary. You know, we all talk about ESG. Well, there's an S in ESG that's often ignored or overlooked. And we felt personally we didn't want to do this. But after talking to our investors, there was more money obviously to be made moving oil from Russia. But the decision was made across the board for every one of our investors not to carry any more Russian oil.
100% right decision, Bob. We did the same, but I envy you being able to ring up a few investors and have and talk it through. As a public company, we've got hundreds or thousands, and we didn't really have that practical ability to consult with them all. But we did the same thing. We met that weekend as management and as a board, and came to the same conclusion as you: is that it's the right thing to do to not chase the last dollar, but to operate your company in a responsible way. So we made the exact same decision. Obviously, it was a good year regardless, so we didn't need to be trading with Russia to make money in 2022.
Yeah.
I won't hog the pound, but as I recall, we spoke to other companies, so it was a consensus.
Yeah, that's right. That's right.
Yeah, excellent. So that thank you, Jeff, for that comment as well. So International Seaways, 78 vessels in sort of the VLCC, Suezmax, LR1, and MR. So the operational strategy for you, being a listed company, is that how do you sort of balance between maximizing returns and sort of the risk management discussed by Bob as well?
Well, it's similar. I always say that in terms of managing a public company, whether it's financial strategy or overall commercial or operational strategy, start with what would I do if I were private, and then come up with what you think is the best plan, and then overlay the fact that the reality is you're public and there's certain expectations. So, I agree with Bob that it's always a good idea to work down your leverage when you can. It provides safety and optionality for the future. When we were spun off from OSG, we had like 40% net loan to value. We worked that down over the next year or so. That would enable us to buy a lot of assets for debt at the down cycle that came in 2018. We worked it down again to 30% net loan to value, which allowed us to do a couple of deals like the Diamond S deal, which was a stock deal but brought a little leverage with it. Came back up to in the 40s. Now we're down below 30% net loan to value and headed lower. And we'll continue to do that because it provides, again, safety and optionality. At the same time, running a public company is a competition for capital. So every day I'm thinking, Lois is thinking, and the whole team's thinking, what can we do to operate this company that's going to bring more equity interest into our company, or frankly, get our share price up. And that's where you balance in the return side of it. I think it's expected of a public company these days that you're going to share some of the wealth, share the upside. And we've certainly done that consistently. Even in 2021, in a terrible year, we were able to give out 6 or 7% of our market cap in return. So we will continue to strike that balance of returning a good portion of the cash flow that's thankfully coming in now, last year, and continuing into this year, with balanced amount of deleveraging too.
Yeah, excellent. And then sort of when you have the geopolitical factors such as the economic slowdown in Europe and the UK and sort of the effect of China potentially coming back, how does that sort of influence the decision going into 23? Are you able to be nimble enough to take this into consideration, or is the strategy set, or how do you look at that?
Yeah, look, I mean, I don't know about you, Bob, as another U.S. guy, or my other panelists here, but the view from the bridge as far as the global economy, I listen to too much business radio, I think, read too much. They don't know a thing, but no idea. It's totally different, right? It's the recession that came from the pandemic. No one could see that coming. This feels like what they call an old-fashioned slowdown, whether it's recession or not. I was reading last night that the inverted yield curve, that means there's a recession. Well, no, that only means that the Fed is trying to slow things down. They're not. It doesn't predict a recession per se. It just correlates with it. So then there's other measures, like there's one that says that if men are buying less underwear, that means that.
Thanks, Jeff.
That's a Bloomberg. I kid you not. Or you can look it up. So, or another one is plastic surgery appointments. If they go down, it's indicative of that. But then there was the CEO of an European airline on this morning before I came over here saying bookings are up, right? So no one has any idea. But and then they always talk about the stock market. Forget about the stock market. What we care about, this is marine money for shipping, like Turner said a minute ago, which is how do we make money? So what's going to affect tanker shipping this year? We think that on balance, the growth in oil demand, which, you know, the EIA, IEA, of course OPEC, are all up to close to 2 million barrels of demand increase this year. That's factoring in this recession or slowdown, whenever it happens, on the back of China returning, which is at least half that growth. So we see significant demand this year, and continued energy security, factors such as the product tanker ban that starts in a couple of weeks. You know, against that is you know, some concerns about the economy, you know, but so we're cautious because we think it's going to be choppy. We don't think that February 5th is going to be a magical uptick in product tankers. It wasn't in crude December 5th. We think that's the wrong thing to look at. It's just a switch being flipped. But we think over the course of the year, on balance, the demand growth in the recovering global economy, especially on the back of China returning, you know, and the low order books, particularly in the second half of the year. You know, people forget that. When is the order book? Well, it's not even. You know, the order book trickles down to almost nothing in tankers, but really that begins in the second half of the year. So we think choppy, but then fundamentally very good for the whole year.
Excellent. And Peder, now moving over to sort of the bulker side, you're in Golden Ocean, 57 owned and operated vessels in the Newcastlemax, Capesize, Camsar, and Panamaxes. Sort of, you just heard Turner Holm from Clarksons is very bullish on the space in general. So do you share that position, or how do you see sort of the macroeconomic and geopolitical events facing your company?
No, we fully share that view. I think we have 94 ships, by the way, but it is a play on China now, and the interesting situation that Turner points out is that we are in a situation where we hardly need any growth on the demand side. I mean, the supply side is so strong, and for the foreseeable future, hardly any ships being ordered, and then we have the whole EXI, CII that is coming in the next couple of years as well. So we are very bullish. We do believe that it may take a little while until you see the sort of full effect of the stimulus packages and China, rebounding fully. But once they are back on track, and it may happen, straight after, the party week as well, and stock building and so on. But it's going to be very, very strong, and it's going to be strong for a long time. So we share that view fully. The risk in this case, at least for us with the ships in the largest segments, is probably the property sector. But we have, as also Turner points out, they've been in a recession for effectively a very long time now, and also the property sector has been, regulated for a long time. So things are improving, and we do all believe that the property sector will also be supported going forward. I don't agree with your dividend yield projections. That is one thing, and we paid out close to $1 billion over the last 2 years, and I think with the balance sheet that we have and the market outlook, we hope that we're going to continue to do that.
Excellent. Then moving over to you, Ivar, in Gram Car Carriers, you were listed this year in January. It's been a very good travel so far. But it's also been quite eventful for the car carriers, and there are several factors leading to that. We've seen an explosive growth in China, and also a lot of chip shortages in Ukraine and other places. How has that affected sort of Gram's strategy, and how do you position yourself with that backdrop?
As you said, we listed about a year ago, so have been performing quite well from a stock market perspective. We came into this market, and just proving Jeff's point here, I mean, we spent a lot of time and effort trying to research and give good, solid predictions of what we think the market was going to develop in our small sector. And we didn't have a clue. We missed the mark by a lot. I mean, the market exploded. We thought it was going to be good, but it was a lot better than anyone had expected. And there's a number of reasons for that. The main reason is probably that both we're tonnage providers and chartering our vessels to what we call the operators, the NYKs of the world, who again hold the contracts with the car manufacturers. So the gentleman from Drury earlier today said that there is no shipping segment, there's a lot of sub-segments. And for us, I mean, we're a extended arm of the outbound logistics of the car industry, which is the largest industry in the world. We're a small and almost insignificant part of that chain until there's a shortage, when people don't get their car, when you have to wait 18 months from when you order a car until you get it delivered. Then it starts creating fuss. And then the price elasticity is simply through the roof. They want to pay for space to get the product out there. And that's what happened basically this year. Predictions were correct in the macro field, i.e. that car production would fall quite a lot, but they were off the mark when it came to the seaborne trade portion of it, because what all car manufacturers did was to concentrate their exports, concentrate their production towards the highest margin models, which are also the models that actually are being exported. There was a chip shortage, put a damper on production for them, meaning they had to be quite rational in how you prioritize your production capacity, which means that although cars produced fell by tens of millions, the number of cars transported by sea hardly didn't fall at all, which is the reason why everybody underestimated the demand for seaborne transport. So what do we do in a situation like that? Well, when every chartering decision you take is a multi-million-dollar decision, you better make it right. And then it's about counterpart risk, basically, providing a sufficient coverage, both in terms of length and tenor, but also trying not to have all your ships to the same charterer coming off at the same time. This is a small segment, so you want to have a balanced portfolio, you want to have staggered maturities, and that's our way of doing risk management. And the next couple of years do look uncertain from a macro perspective, and car sales are highly sensitive towards macroeconomic development and personal income development in the major economies of the world. So these numbers will fluctuate. So when the uncertainty is there, well, what do? From our side, we try to take cover going for long charters towards the good names, the solid counterparts of the world, and that's what we've done. And setting up the company to pay double-digit dividends for at least a handful of years, which we have in control, basically, based on the charter book we have. And then let's see. You can't really make proper predictions way out ahead. And the point of this, from our perspective, is that the profitability, but also the risk for shipping segments, all of us, I believe, is not in the headline figures. It's what's on level 2, 3, 4, and 5, down in the macroeconomic development, the subsegments, the regional differences, the change in trade patterns, etc., etc. And just to make one comment on the S, as Bob and Jeff have spoken about, the impact from the Russian-Ukraine conflict on the car carrier market is very limited, but we all have a large number of Ukrainian and some of us have Russian crews on our vessels, so that's been our main concern, to make sure that our crew and their families have been safe, together with our crewing partners. We've spent quite some time and money to set up social programs, helping to take families out of Ukraine, offer relocation programs, etc. And that's been much appreciated, and when you run ships where you are dependent on the quality and the loyalty of the crew, I think that's a good investment.
Yeah, definitely. So then switching over to a bit more sort of on the supply side, we've touched upon it a little bit with sort of new regulations coming online with the IMO, EEXI, and CAI. I mean, in 2020, we had a lot of attention on scrubbers. There were a lot of decisions to be made there. Now we're in the position where there's a very low order book for tankers and bulkers, so much larger for car carriers. But Ivar, looking at you as well, when you're looking at the fleet and how you position yourself and these new technologies and regulations coming online, being closer to the end user with sort of the electrical vehicles and the car manufacturers, do you need to look at this in a different way than for example, tankers and bulkers, or?
Yeah, I think that's right. I think it's hitting our sector probably, if not first, at least at the early stage. If you buy a car from Volkswagen today in certain countries in Europe, you can get it delivered with a emission certificate, which is a sort of a cradle from throughout production, including logistics, which means that we, as part of the logistics chain, also have to offer and provide the emissions data to our end users, to our customers. That's been going on for quite some time. And I think it's probably going to come, particularly in containers as well. But, and that means that there will be more focus. It's already started. You mentioned the order book in car carriers. All vessels are dual fuel. A handful of them, probably more, also claim to have ammonia capability, methanol ready, etc., etc. People don't know what the future is going to hold in terms of fuel, but you try to position yourself at least. And in our sector, both the EEXI and CII will have operational impact. These vessels typically spend 30% of the time in port doing cargo operations. So of course the fuel efficiency is extremely important, and something like shore power, for instance, would have a large impact for. It's a relatively small investment to put a battery pack on these vessels for shore operations, but it will require standardization among ports, etc. So you can't have 25 different standards and systems. So I expect that that's a trend going to come, particularly here in Western Europe, perhaps also in the US, where you'll see pressure eventually coming from the maybe consumer-led pressure, if you like, to have a more sort of decarbonization effort, not just on the vessels trading, because there's a lot has been done and will continue to be done, but for the products we carry, the vast majority of emission comes from cargo handling in port, not from when they're at sea.
Yeah, excellent. And then Peder, considering sort of the new regulations and your fleet composition, you're not always carrying the cleanest of cargoes. How does that affect your decision making, and also looking at investors? What are they focused on returns, or is it emissions, or what sort of your thinking there?
I think 2 years ago, when sort of the green wave really hit its peak, you know, investors were very concerned about the sort of the portion of coal that we carried. And at that point, you know, due to the size of the fleet composition that we have, are by far the largest cargo that we have in share of cargo is iron ore. The share of coal has increased, but at the same time we've had a global energy crisis, and the acceptance that we need coal in that energy mix for a while is much more accepted now. So we actually see much more focus on emissions from investors. We have, over the last 2 years, bought 28 ships and sold 11, and are continuing to renew the fleet. Obviously, from an efficiency point of view, in terms of having the most efficient fleet and churning the most out of the market, but also from an emissions point of view. In that period, we also ordered 10 new buildings, and in dry cargo, due to the trading patterns that we have and the odd places that we need to suddenly bunker, the dual fuel option was not the best for us. So we have that optionality in the engines, but we have opted for conventional engines. But obviously the most modern ships that will emit less and be the most efficient. So we do see transitional funds coming in and looking at our fleet with the lowest average age and stating that as more important right now than the fact that we carry coal.
Yeah, no, excellent. And sort of while we're on the topic of investors, I mean, we saw sort of now that the position in international Seaways, where there's been some unexpected events where John Fredriksen comes in and sort of buys a larger stake of the company. Sort of how does that influence the decision making and sort of these unexpected events? Does it influence how you look at things and then sort of how you handle the corporate strategy, or is it a non-event?
It's just part of the normal the unexpected is to be expected. Whether it's the macro changing or a new investor coming along, that's just a part of the drill, right? So we were and are flattered to have such a savvy, maybe the most respected, successful, savvy investor and operator in shipping take a large stake in our company. Obviously, he and his team saw a lot of value there. We had done the merger with Diamond S that brought a lot of product tankers, and last spring it was beginning to become clear that product tankers were going to be the leader of the resurgence in tanker rates, and we were trading at a particularly large discount to NAV, and I think, like other shareholders, but just in a lot bigger way, he saw and acted on an opportunity to invest in a quality company at a low price, and he's made a lot of money. So I think it's great. We have a good dialogue with him like we do with all of our, we'll talk to any of our shareholders, but obviously we have a regular program to reach out to our large shareholders, and he's part of that, or his team is part of that. So
Yeah.
all good.
Excellent. And I guess we have 1 or 2 minutes left, and I'll leave the last question for you, Bob. So being private, do you think you're able to be more nimble and sort of handle these uncertainties, or sort of what's your view on?
Yes.
Yes.
Next question. Everyone awake out there? It's hard to tell up here with the lights in your eyes. But I've been sitting here thinking for a bit about what we're all trying to do, and we are different segments of shipping. I think, but we all try to achieve the same objective, which is make money by a similar strategy, and that is, the long-term return on shipping is kind of lousy, to put it politely, but we all prepare ourselves on our balance sheet with our fleets, with our time charter strategy, with our spot market strategy, whatever it is, to lay down as many options as possible. And the past 20, 30 years has enabled us to compete, I think, efficiently and effectively together with new regulations, whether it's from double hulls up to the latest anti-carbon regulations, so that the lowest cost producer can't drive our rates down. So I think overall that's been very, very healthy for all of us. But at the end of the day, we're all in the business for the unknown. When we all put scrubbers, or some of us put scrubbers on our ships a few years ago, none of us would have seen COVID. None of us would have seen that the real benefit to having scrubbers was the Ukraine war that blew out the spreads between various fuel components. So that's what we prepare ourselves for. We don't really think we're going to make a lot of money on the day-to-day business, but we have to do it. We have to be good. We have to follow all the regulations. We have to be efficient. We have to have a good capital structure. And the times that are good for us is that, as everyone said, Ivar said, when they need that car on the ship, they'll pay anything for it at the end of the day when they really, really have to. And what we prepare ourselves for, and our shareholders, is that when they really, really have to, we're there to optimize our balance sheets and our income statements to harvest that money and to give it back to our investors. As a private company, I can look at our fleet and say, I want to sell, because right now the rates are through the roof, and speculators are buying those last couple of ships at high prices. And I say, all right, those high prices are well above replacement cost, well above the discount rate that I put on them, because I know that when rates are really high and asset values go high, they don't belong there forever. So as a private company, I can sell, and I don't have to hang in there, for the long term and watch it come down again. My friends on the public side provide a different service. They provide a platform, a public platform, so everyone in this room can go in and buy a piece of it, and you can make your own decision whether that NAV is really reflective of what the future is going to be. But what I also believe is that, this too shall pass. And I told my wife that last January. Actually, she told me last January when I was really depressed about the market. And she said, don't worry, things will get better. I said, sweetheart, we already lost a couple $100,000 this morning before I got out of bed. And we did the same thing over the weekend. And sure enough, things changed, not in the fashion that we expected. But just as that passed, that bad market, the good market's going to pass also. And I think everyone on the panel here has a balance sheet and a strategy that will enable them to survive the next downturn.
Excellent. I think that sums it up quite nicely. Thank you all for listening and for attending the panel.
Thanks a lot.